Why investor returns often lag total returns. As I've covered in previous articles, a fund's investor returns, also known as dollar-weighted returns or internal rates of return, often differ from its reported total returns because of the timing of cash inflows and outflows. Reported total returns, aka time-weighted total returns, assume a lump sum investment made at the beginning of the period, with no purchases or sales made during the interim. But because investors often buy and sell funds for various reasons, their actual results can vary significantly if, for example, they buy more shares right before a major downturn or sell shares and then miss out on subsequent gains. To estimate how ARKK's shareholders have fared, I looked at monthly asset flows since inception, as well as asset totals at the beginning and end of each period. I then used these monthly cash flows to calculate an internal rate of return, which measures performance for the average dollar invested in the fund. As the chart Exhibit 1 on the top illustrates, investors' actual results lagged reported total returns overall for trailing periods by large margins. Over the past 5 years, for example, the fund's 41.3% annualized return places it among the top 5 best-performing U.S. equity funds and ETFs, and it trounced the S&P 500, the benchmark listed in its prospectus, by more than 15 percentage points per year. After the adjusting for the timing of cash inflows and outflows, though, we estimate that investors earned less than a fourth of that return. ARKK's estimated 9.9% investor return over the past 5 years lagged its benchmark by about 8 percentage points per year. The investor return gap hasn't been quite as large over the past 12 months, but absolute performance has been considerably worse. We estimate that shareholders suffered a 12% dollar-weighted average loss, which is almost 3 times deeper than the fund's 4.3% reported loss over that span. What's more, ARKK has experienced breakneck volatility, making any risk-adjusted measure of its dollar-weighted returns even worse. What went wrong? The difference between ARKK's time and dollar-weighted returns comes down to a simple reason: most of its returns came when fewer shareholders were around to benefit from them. Even during 2017, when it posted an impressive gain of 87.4%, partly driven by a 1,300% run-up in then-top holding Grayscale Bitcoin Trust, it averaged only about $116 million in assets. By the time assets peaked around $25.5 billion in June 2021, performance was just about to drop off. Previously high-flying holdings such as Teladoc Health, Roku, and Zoom Video Communications have crashed back to earth in recent months, and the fund shed about 24.9% of its value for the year-to-date period through November 30, 2021. A look at the fund's estimated net inflows year by year sheds more light on why shareholders' results have lagged reported total returns by such a wide margin. As shown in Exhibit 2 in the bottom chart, the lion's share of ARKK's net inflows took place during 2020 and 2021. Combined flows for those 2 years represent about 90% of all cumulative net inflows since inception. Lessons from the flood. While ARKK's story isn't over, its latest chapter contains some lessons for investors. Triple-digit returns don't repeat. As we've pointed out in the past, it's highly unlikely for any fund to continue posting chart-topping returns year after year. Funds can typically rack up gains of 100% or more only by making concentrated bets on individual stocks in the market's hottest sectors, which usually means taking on nosebleed levels of valuation risk. That often leads to sharp losses when market trends reverse course and valuations drop to more realistic levels. Overall, the gap between shareholders' actual returns and reported total returns underscores the perils of getting caught up in the hype of funds with high-flying returns, which usually leads to disappointing results.